Hey everyone, welcome back to Delta Edge, your ultimate guide to the stock market. Today, we're diving into an exciting topic. What are the best options trading strategies for beginners? Whether you're a seasoned investor or just starting out, this video is packed with insights and tips. Let's get started. Alright folks, let's kick things off with a classic, the covered call. This strategy is about as straightforward as it gets, and it's perfect for beginners. Here's the deal. You own a stock, let's say Reliance Industries. You're bullish on its long-term prospects, but you wouldn't mind pocketing some extra cash along the way. That's where covered calls come in. You sell a call option on those Reliance shares you own. Selling a call option gives the buyer the right to buy your shares at a predetermined price before a certain date. Think of it like renting out your house. You collect rent premium from the tenant, option buyer. If Reliance goes up, fantastic. You might have to sell your shares, but you'll still make a profit from the premium and the capital appreciation. If Reliance tanks, your losses are limited to the difference between the stock's purchase price and the strike price, minus the premium you received. We all know the market can be a wild ride. One day, stocks are soaring, and the next, they're plummeting. It's enough to make any investor's head spin. But fear not, my friends, because the protective put is here to save the day. This financial tool can be your best friend in turbulent times. It's like insurance for your portfolio. Just as you wouldn't drive a car without insurance, you shouldn't navigate the stock market without some form of protection. Let's say you've got your eye on Infosys. This tech giant has shown impressive growth, and you believe in its future. You believe in the company's long-term potential, but you're a bit wary of short-term volatility. Enter the protective put. This strategy can help you sleep better at night. By purchasing a put option on Infosys, you're essentially buying the right to sell your shares at a predetermined price, regardless of how low the stock plummets. This means you have a guaranteed exit strategy. Think of it as a safety net. Just like a trapeze artist wouldn't perform without a net, you shouldn't invest without some form of downside protection. Now, this safety net doesn't come free. You'll have to pay a premium for that put option. If Infosys rallies, awesome. Your investment grows. You might lose the premium paid for the put option, but your stock gains are unlimited. This is a small price to pay for peace of mind. And if the market takes a turn for the worse, no sweat. You've got a plan in place. You can exercise your put option and sell your shares at the strike price, limiting your losses. This way, you can avoid the panic that often accompanies market downturns. Protective puts offer downside protection while still allowing you to participate in potential upside gains. It's a win-win strategy for savvy investors. So, next time you're feeling anxious about market volatility, remember the protective put. Shield your portfolio like a boss and invest with confidence. Alright, all you bulls out there, this one's for you. The long call is a classic bullish strategy that allows you to leverage your capital and potentially generate outsized returns. Let's say you've got a hunch that HDFC Bank is about to break out. You're feeling bullish, but you don't have a ton of capital to throw around. Instead of buying HDFC Bank shares outright, you buy a call option on the stock. This gives you the right to buy HDFC Bank shares at a specific price before a certain date. If HDFC Bank's share price skyrockets, the value of your call option will soar too. You can then choose to exercise your option, buy the shares and sell them for a profit, or you can simply sell the option itself for a tidy gain. Of course, there's always the risk that HDFC Bank's share price doesn't move as you predicted. Just remember to manage your risk and never invest more than you can afford to lose. Now, not everyone's a raging bull. Some of us are a bit more cautious. If that sounds like you, then the long put might just be your new best friend. Let's imagine you're feeling bearish about Tata Motors. Maybe you think the global chip shortage will continue to weigh on their production. Instead of short selling the stock, you can buy a put option on Tata Motors. This gives you the right to sell Tata Motors shares at a predetermined price before a certain date. As Tata Motors' share price drops, the value of your put option increases. You can then choose to exercise your option, sell your shares, and pocket the difference. Or you can simply sell the option itself for a profit. Of course, if Tata Motors defies your expectations and rallies, your put option will lose value and eventually expire worthless. Just remember, even though options trading offers limited risk, it's crucial to manage your trades carefully. Now, let's step it up a notch and explore a more sophisticated strategy: the bull call spread. This strategy is particularly useful for those who want to take advantage of a bullish market sentiment without exposing themselves to unlimited risk. Imagine you're bullish on Bajaj Finance, but you're not convinced it's going to skyrocket overnight. You think the stock will rise, but at a more measured pace. You believe a steady climb is more likely, rather than a sudden surge. This is a common scenario for many stocks where the growth is gradual and consistent. This is where the bull call spread comes in handy. It allows you to capitalize on this steady upward movement while managing your risk effectively. Instead of buying a single call option, you buy a call option with a lower strike price and simultaneously sell a call option with a higher strike price. This combination creates a spread that can be very advantageous. Both options will have the same expiration date, ensuring that they are aligned in terms of time frame. This synchronization is crucial for the strategy to work effectively. By selling that higher strike call option, you collect a premium that helps offset the cost of buying the lower strike call option. This premium collection is a key component of the strategy. This reduces your overall risk and limits your maximum potential loss. The premium collected acts as a buffer, reducing the net cost of the trade. If Bajaj Finance's share price rises as you predicted, the value of your lower strike call option will increase, while the value of your higher strike call option will decrease. This interplay between the two options is what generates your profit. This difference in value translates into a profit for you. The higher the stock price rises, the more valuable your lower strike call option becomes, up to the point where the higher strike call option caps your gains. If the stock price remains below the strike price of your lower strike call option, both options will expire worthless, and you'll lose the net premium paid. However, this loss is limited and known upfront. This controlled risk makes the bull call spread an attractive strategy for traders who want to participate in potential upside gains while minimizing their downside exposure. It's a balanced approach that offers a good mix of risk and reward, making it suitable for various market conditions. Alright, my fellow bears, it's time to unleash the power of the bear put spread. This is a strategy that can be a game changer for those who know how to use it effectively. This strategy is perfect for traders who are bearish on a particular stock and want to profit from a potential decline while limiting their risk. It's a way to capitalize on a falling market without exposing yourself to unlimited losses. Let's say you're feeling bearish on ITC. You've done your research, analyzed the charts, and you believe the stock is poised for a downturn. You believe the stock is overvalued and due for a correction. Maybe the fundamentals don't support the current price, or perhaps there are external factors that could drive the price down. Instead of short selling the stock, which can be risky and requires a margin account, you can implement the bear put spread. This strategy offers a more controlled way to bet on the stock's decline. This strategy involves buying a put option with a higher strike price and simultaneously selling a put option with a lower strike price. Both options should be on the same underlying stock and have the same expiration date. Both options will have the same expiration date. This synchronization is crucial for the strategy to work effectively. By selling the lower strike put option, you collect a premium that helps offset the cost of buying the higher strike put option. This premium collection is what makes the strategy more affordable. This reduces your overall risk and limits your maximum potential loss. Unlike short selling, where losses can be unlimited, the bear put spread caps your losses at a predetermined level. If ITC's share price falls as you predicted, the value of your higher strike put option will increase, while the value of your lower strike put option will decrease. This difference in value is where your profit comes from. This difference in value translates into a profit for you. The maximum profit is achieved if the stock price falls below the lower strike price at expiration. This controlled risk makes the bear-put spread an attractive strategy for traders who want to profit from potential downside moves while minimizing their potential losses. It's a sophisticated yet accessible way to navigate bearish markets. So if you're looking to profit from a stock's decline without taking on excessive risk, the bear-put spread might just be the strategy for you. It's all about smart trading and managing your risk effectively. So there you have it, folks. 6 powerful options trading strategies that can help you take control of your investments and potentially boost your returns. If you found this video helpful, give it a thumbs up and subscribe to Delta Edge for more insights into the stock market and investing. And don't forget to hit that notification bell so you never miss an update. Got questions or thoughts about options trading strategies for beginners? Drop them in the comments below. Thanks for watching and happy trading.